All right, let's begin. So, chapter 13, topic 7, risk, cost of capital and valuation. Look at question number 1. Project risk. If you can borrow all the money you need for a project at 6%, doesn't it follow that 6% is a cost of capital for the project? All right. So this question is talking about project risk here. So they're telling you if you can borrow all the money you need for a project at 6%, doesn't it follow that 6% is a cost of capital for a project? So the answer here is no. All right. Because the cost of capital is depending on the risk of the project, not by the source of the money. So when you're talking the risk of the project means whether can this project work or not, whether can this project what do you call that, could be successful or not. But the cost of this project is basically supported by debt and is being charged 6% on it. So this is basically charges. This does not replicate or does not represent the project risk. All right. Moving on to the second question here. All these are just theory questions. So if you guys have any doubts or need further understanding, you can always refer to the textbook and also to your lecture slides. So number 2 here, why do we use an after-tax figure for cost of debt but not for cost of equity? So as you know, capital structure could be consist of debt and equity. Okay, so the question here is, why do we use an after-tax figure for cost of debt but not for the cost of equity? So very simple. To answer this question, interest expense, because interest expense is tax deductible. Okay, whereas for equity, there are no interest. So that's why it doesn't make any difference. Debt, there are interest expenses. That's why it is tax deductible. Okay, so there is tax deductible for debt. So you need to take into consideration of after-tax figure. Moving on, question number 10 here, beta. Okay, so beta usually represent risk. All right, so next question here is beta. Okay, beta also could be known as risk. So over here, what factors determine the beta of a stock? Define and describe each. Okay, what is beta? So beta is the measurement of responsiveness. Okay, measurement of responsiveness of a security returns towards a market movement. Okay, so what is beta? Beta is to measure the responsiveness of a security returns towards a market movement, or in other words, the sensitivity, okay, or the volatility of a security according to the market movement. So this is what it means. Okay, so there are 3 factors that will impact the firm's beta. All right, so 3 main factors. Number 1 is revenue. Number 2 is the operating leverage. And number 3 is the financial leverage. All right. So to understand further what all these 3 factors or how could it impact the firm's beta, you may refer to the textbook. Okay, go and find out. All right, go and find out. Okay, so these 3 are factors that will affect beta. And what is beta again? It's a measurement of responsiveness of security returns towards a market movement. All right, this is basically the theory section for today. Okay, go and refer, go and study your textbook, go and refer back to your lecture slides to have better understanding or to have a further elaboration on it. Again, the importance of finance is not basically memorizing. It's basically understanding the concept. So sometimes you need to spend some time to go and go through it. Okay, so basically now we'll go into the calculation section. So today calculation is something that nothing new, actually something that you already used to see before in your earlier financial unit. So basically calculating cost of equity, cost of debts, and WACC. So let's go through it together. So some of the formula being used by your lecturer for the corporate finance might have a slight difference on the way that the formula is being written out. So you might want to know the difference between the current situation, the current formula, and whatever you have learned before that. Of course, it's interchangeable, it's interusable also. So just that you don't be confused when you look at the solution later on when it's being uploaded. So let's look at this calculation question here. Calculating the cost of equity. The Deep Wheat Corporation common stock has a beta of 1.21. If the risk-free rate is 3.5% and the expected return on the market, so return on the market is 11%, what is the cost of equity? So cost of equity is RE, but in your lecturer slides is RS. S stands for stocks, cost of stocks. Okay, so it has the same meaning, RE or RS. So you need to find this. So how do you find cost of equity? One simple formula, which is the Kappa model. So Kappa model is cost of equity equals to risk-free plus beta market return minus risk-free. Okay, so find it. Simple. Risk-free 0.035, beta 1.21, return on the market 0.11 minus 0.035. So this will give you 0.1258 or 12.58%. So whenever they call you to find the cost of equity, you can always use the Kappa model. Okay, the Kappa model. Question 2 is to find cost of debt. Okay, so let's see cost of debt. Advanced Incorporation is trying to determine its cost of debt. Cost of debt is written as RD. In your lecture, he write it as RB. B stands for bond, cost of bond. Okay, Advanced Incorporation is trying to determine its cost of debt. The firm has a debt issue outstanding with 17 years to maturity that is quoted at 95% of face value. So present value is 95% of 1,000. So it's 950. The issues make semi-annual payment. Semi-annual, so period times 2, 34. Payment divided by 2, 0.08 divided by 2 times 1,000. So your payment per semi-annual is $40. What is the advance pre-tax? And if the tax rate is 35, what is the after-tax? So RD and RDAT. These two you need to find. Okay? So to find bond, okay, or no, to find cost of debt, you use the bond valuation formula. PVA equals to PMT multiplied by 1 minus 1 plus R power of T divided by R plus FV over 1 plus R power of T. So which one is your RD? The R. Okay, the R is your RD or also your RB. Okay, it's all the same terms lah, basically. So to prevent, I think a lot of you already have your financial calculator. Then of course you can straight away key in your financial calculator. Present value negative 950. Future value for bonds is always 1,000, so no difference. PMT 40. Period 34. Compute IY. Okay, your IY here provided to you 4.28. It's for semi-annual. So this is not your RD yet. Okay, your RD is for whole year. So 4.28 times 2, you get 8.56%. This is the RD. So they also call you to find the cost of debt after tax. So so this is basically the formula is RD multiplied by 1 minus T. So 8.56, 1 minus 0.35. So the RDAT that you should be getting, it's 5.57. Okay, 8.56 and 5.57 after tax. So far, any issues? All good, very good. All right, not hard at all. Huh? This is something that you did before. Again, it's not rocket science. All right, so next, of course, next already know how to count equity, know how to count debt. They want you to count the whole WACC. So the WACC formula that I'm familiar and the one that I always use is like this. WACC equals to the sum of weightage times cost of equity. Weightage multiplied by cost. All right. Okay. So if the question got equity and debt, this is how it looks like. Okay. But given to you from your lecture slide, it's written this way. S over S plus B multiplied by return on stock, okay, plus B over S plus B multiplied by return of bonds multiplied by 1 minus T. So this is what written for you into your what you call that, in your lecture slides. It's the same thing. Okay, it's up to you which one you like to use. In the end, you get the same answer. So look at question 3 here. Mulinex Corporation has a target capital structure of 70% common stocks. So 70% on common stocks, which also means your equity. Okay, and then 30% is on debt. Okay, 30% is on debt. Cost of equity is 13%. Cost of debt is 6%. Relevant tax rate is 35. What is the WACC? So just count. They already give you all the information. So WACC weightage 0.7 multiplied by 0.13 plus 0.3 multiplied by 0.06 multiplied by 1 minus 0.35. So we get a WACC 0.1027 or 10.27%. This is WACC. All right. Very straightforward, very simple. Okay. So now, questions, moving on to question number 6 here. Now you'll try to use the formula derived from your lecturer. So question 6 here, Miller Manufacturing has a target debt equity ratios. Debt equity ratios means that debt divided by equity, okay, equals to 0.55. So 0.55 divided by 1 is equal to 0.55 also. So in this case, 0.55 is your debt, 1 is your equity. Okay? Your debt is 0.55, your equity is 1. So your whole capital structure, which is the whole market value of this thing, is 0.55 plus 1. So it's equal to 1.55. So the question tells you, Miller Manufacturing has a target debt equity ratio of 0.55. Its cost of equity is 14%. cost of debt is 7%. If the tax rate is 35%, what is the Miller's WACC? Okay, so the WACC will be like this. All right, the debt, the equity first. Equity, our market value, equity is 1. Okay, 1 divided by 1.55 multiplied by your equity, 0.14. Debt is 0.55 divided by 1.55 multiplied by 0.07. 1 minus 0.35. So this will give you a 0.1065 or 10.65%. Can see, okay? So basically, your D is your B, your E is your S, okay? B over S. All right. So this is S over S plus B. This is S over S plus B times RS. This is B over S plus B times RB times 1 minus T. This is the formula your lecturer used. Okay. Now you can see, right? It's actually similar to the WERE plus WDRD. Okay, it's the same thing. All right, different description than but you have the same definition. Okay, so next we'll go to question 7. Question 7, it's a bit confusing, so listen to me carefully. Also playing with debt to equity. So question 7 here, Pharma Lamas has the weighted average cost of capital. Okay, Pharma Lamas have a weighted average cost of capital of 9.8%. The company cost of equity or RS, cost of equity, is 13%. And its cost of debt is 6.5%. The tax rate is 35%. What is Pharma's debt to equity ratio? Debt to equity ratio also equals to P divided by S. This is the whole thing they want to find. So they already give you a WACC. So WACC is 0.098 equals to stock, equity. Let's talk lah. S over V. V is the whole market value. Okay. S plus B equals to V. Okay. So you don't know the weightage. So S divided by V multiplied by 0.13 plus B divided by V times with 0.065, 1 minus 0.35. So 0.098 V divided by S. So minus of the V and then minus of the S. So this will become 0.13. But this one will be B divided by S times with 0.04225. The problem now here, from this equation, you want to equalize it. This is the heading. So the formula for this is V over S is equals to 1 plus B over S. So replace this into there so that you become 0.098 1 plus B over S equals 0.13 plus 0.04225 BS. Okay. All right. So shift around in the end. Okay. 1 BS minus this will be 0.05575 BS equals to 0.032. So B over S is equal to 0.032 divided by 0.05575. So this will give your debt to equity ratio 0.5740. B over S is equals to D over E, debt to equity. So that is how you get your answer. As I mentioned, you just need to know VS is equals to 1 plus BS. Then you can find the equalizer and you can equalize it. Okay, it's actually quite straightforward. When you can equalize it, it's going to be quite straightforward. See, this is the whole calculation. Very easy, very simple. Do it slowly. Okay, do it slowly. All right. Now, moving forward to question number 10 here. Corsair Incorporation has a target debt to equity ratio of 0.45. Its WACC is 11.2. 0.122 WACC, yeah? Okay, and the tax rate is 35. So A, if Corsair cost of equity, RE, cost of equity, it's equals to 15%, what is the pre-tax cost of that? Okay, so what is the RD? So use your WACC. WACC 0.112 equals to your weightage here on equity. Equity is 1, okay, 1 over 1.45 times 0.15 plus 0.45 over 1.45 times RD times 1 minus 0.35. So find your RD now. Okay, find your RD now. You shift around your RD, you'll be getting 0.0424 or 4.24%. Okay, so now to shift or not? Count one by one with the calculator. 1 divided by 1.45 times 0.15. What do you get? Let's calculate. 1 divided by 1.45 multiplied by 0.15. 0.1035. Okay? 0.112 equals to 0.1035 plus 0.45 divided by 1.45 times 0.65. 0.2017. Okay, so 0.2017 RD is equals to 0.112 minus 0.1035. So you get the 0.0085 RD 0.0085 divided by 0.2017. You get 0.0421. So it's around 4.21%. So you realize there's a bit different. Okay, it may be due to decimal point. So no worries. Okay, no worries. I already show you step by step here. All right. So this is how you calculate it. So this is part A and E. Part B, they tell you if instead you know that the after-tax cost of debt is 6.4%, what is the cost of equity? So part B, they give you the opposite. Okay, the opposite. Your RDAT is 0.064. So repeat this, 0.112, okay, equals to 1 over 1.45 multiplied by your equity you don't know, plus your debt. Okay, this is after tax already, so no need to count. 1 minus 0.35. So straight away. Okay, so this will manage to give you your RE equals to 0.1336 or 13.36%. This is a very simple calculation. You just go and jumble it up, giving you one to find the other one. So it should be quite straightforward. No rocket science here yet. This is just to assist you to know how to calculate, how to change around things, and etc. Okay, hopefully this is not an issue to you. All right. So any questions so far up until here? Are you okay? Clear. Very good. Thank you, Viley, for responding to me. Okay, so we move on. So these next two questions are usually more likely or more similar to an exam question. Okay, so look at question number 11 here. Given the following information for Huntington Power, find the WACC, assume the company tax rate is 0.35%. So they tell you the information here. The debt, okay, Huntington debt is 5,000 units, okay, of 6% coupon bond outstanding. All right, so your payment is 6% for now. 1,000 par value, that means your FV is 1,000. Okay, 25 years to maturity. Selling for 105, so present value is at 105% of 1,000. So it's 1050. The bonds make semi-annual. So semi-annual straight away, n times 2 equals to 50. Payment divided by 2 times 1,000 equals to 30. So this is the information of debts. Next, common stocks. Common stocks means equity. So under equity, you got 175,000 shares outstanding. Okay, selling for $58 per shares. The beta 1.1, and your market is 7% market risk premium. So when they tell you market risk premium is basically return on market minus RF straight away. So this is 0.07 and your risk-free rate is 5%. So these are the information given to you. They want you to find the WACC. So very easy. Number one, first thing all find the market value. Okay, find the market value, how big each of is. So the market value of your equity is equals to 175,000 multiplied by the current selling price of $58. So the value of your equity is actually $10,150,000. Your debt, on the other hand, it's 5,000 unit only. But then each unit are sold at 1050. So this will give you 5,250,000. So your market value is 15,400. This is your market value. Okay. So with the market value, you can count your weightage. So count weightage of E is equals to 1015000 15,400,000. Okay, your weightage equity here is how much? Let me see. WE, count your WE. Let me count 1015023 divided by 154,000. So 0.6591. Okay. Weightage of that is 5250 divided by 15400,000. Okay. 5250123 divided by 15400,000. 0.3409. Okay. So this is the weightage of equity and the weightage of debt. So moving on, after having the market value, finding the weightage, you want to find the RE. So use CAPM. RE equals to RF plus beta RM minus RF. So 0.05 plus the beta given to you, it's 1.1. Again, market risk premium straight away given to you is 7%. So you can count your cost of equity, 0.1270. Next, count your cost of debt. Okay, cost of debt. So cost of debt, use financial calculator. Present value, negative 1050. Future value, 1000. Payment, 30. End period is 50 years. 25 times 2. Compute IY. So you get 2.813%. And this is for semi-annual. So to get RD is 2.813 times 2. So it becomes 5.63. Okay, 5.63. After having this, calculate now your WE, the WACC. So WACC equals to weightage of E 0.6591 times your equity 0.127 plus 0.3409 times with this 0.0563 times with 1 minus 0.35. So in the end, you will get the whole WACC is 0.0962 or 9.62%. Okay? Can, huh? So, very simple. This kind of question, they've given you this kind of information. You need to find the market value first. what is the value of equity, what is the value of debt, total up become the market value. Then from there, you can count the weightage. Okay, once you got the wages, proceed with the cost of equity, the cost of debt, then you can calculate the whole equation. Very simple. Okay, very easy. Just read the question carefully and follow the question requirement closely. Okay, so let's try again with question 12. It's a question exactly the same like this. So, but the information are given to you are scattered around. That's why you need to identify the question properly. So, Titan Mining Corporation has 9.3 million shares of common stocks. So, equity, 9.3 million of it outstanding, and then 260,000 on bonds. So, the debt of bonds is 260,000. You see information everywhere. So 260,000, 6.8% semi-annual bond. So you know the payment 0.068 divided by 2 times 1,000. So the payment is 34 per semi-annual. Par value is 1,000. Standard now, this one cannot change. The common stock currently sells. Then suddenly jump back here. Common stocks currently sell at $34 per shares. And has a beta. Suddenly they talk about here. They purposely meant to confuse you. And then go back, and the bonds have 20 years to maturity. Because semi-annual times 2 equals to 40. 40 period. And sell for 104% of par. So selling price 104% of 1,000, 1040. Okay, the market risk premium, market risk premium, RM minus RF is equal to 7%. T-bills are yielding at 3.5. T-bills means risk-free rate, 0.035. Treasury bills, government bonds are all risk-free rate. Okay, and the Titan Mining is having at a tax rate of 35% again. So these are the information given to you. A, what is the firm's market value capital structure? So now they tell you detail. They want you to find the market value structure. Find the market value. So again, do one by one. Equity market value is equals to 9.3 million multiplied by $38 per share. 34, sorry. $34. Okay, $34 per share. So find out how much is this volume here. Okay, 9.3 times 34, you get 316,200,000. Your debt now, 260,000 times 1.04. So it's 1040 per bond. So this will give you 270,400,000. So total of this together, you get 586,600,000. This is your market value. So now find the WE. WE is 316,200,000 divided by 586,600,000. Okay, 0.5390. Debt 270,400,000, 586,600,000. So 0.4610. Got WE already. Okay, capital structure done. Part B, if Titan Mining is evaluating a new investment project that has the same risk as the firm's typical project, they want to invest a new project having the same risk as this, what rate should the firm use to discount the project cash flow? So basically, they want to count the WACC. So, simple. Find the cost of capital. Okay, find the cost of capital. Risk-free rate given to you 0.035 plus the beta given to you 1.2 times your market risk premium is 0.07. So your cost of equity is 0.1190. Next, calculate the cost of debt. Okay, PV, the present value is negative 1040, FV 1000, payment 34, and 40 compute IY 3.22. This is semi-annual. So for whole year, this RD equals to 3.22 times 2, 6.44%. So now you are having everything ready. So WACC equals to WE 0.5390, RE 0.1190 plus WD 0.4610 times with 0.0644, 1 minus 0.35. So the final answer for your WACC is 0.0834 or 8.34%. Okay, so this is similar to question number 11. And these are usually tend to be more likely to be an exam question. It's more complete. They want you to find everything step by step, one by one, to showcase your understanding about this type of question. Okay? No rocket science, actually quite straightforward, very easy. Now, the following question is regarding on IRR and the way you evaluate your project. So let's see what is the question about. So let's look at the detail of the question first. So if you look at the question, there are project W, X, Y, and Z. The beta for W, X, Y, and Z, 0.8, 0.95, 1.15, 1.45. Okay, IR, internal rate of return, 9.4, 10.9, 13, 14.2. So the T-bill rate, okay, the risk-free rate is 0.035. And the expected return on the market, RM, is 0.11. So A, which project have a higher expected return than the firm's 11% cost of capital? Okay. So this is basically A, they want you to compare IRR versus 11%. So based on this, if you use 11% as benchmark, all right, this one is less than 11%. Okay, you reject. This one is also less than 11%. You reject. So you accept 13 and 14.2. So this is what you find out. All right, that's all. So which project have a higher expected return than the firms? Y and Z. So B, which project should be accepted? Okay, so instead of just comparing to the cost of capital, you want to count which project should we accept. So this is basically asking you to count the return of equity. Okay, they want you to find the return of equity. You need to find the RE. So W, the RE is equals to RF 0.035 plus the beta of 0.8 multiplied by RM 0.11 minus 0.035. So for W, your cost of equity is 9.5%. X, repeat 0.035, just change the beta, only the beta is different. 0.95 minus 0.035. So for X, you get 10.9%. Y, repeat again, 1.15. This will give you 12.13%. And lastly, Z. Give you 14.38%. So you can put it here. All right. Put it here. 9.5. 10.63. 12.13. 14.38. This is your cost of equity. So based on your cost of equity, okay, based on the cost of equity, you accept which one and you reject which one. Compare cost of equity with your IRR now. Okay, compare cost of equity, your IRR. So internal required rate of return, okay, you require to return 9.44, but your cost of capital itself is only 9.5. So you cannot get 9.4. So reject. You need to have 10.9, but your cost is only 10.63. Yes, accept. Okay, this one also 13 more than 12.13, accept. This one is higher cost than the required rate. So reject. All right, this is part B. So now part C. Which project would be incorrectly accepted or rejected if the firm overall cost of capital was used as a hurdle rate? Okay, which one is incorrectly accepted or rejected if you are using the firm's overall cost of capital as a hurdle rate? So if you are using this one as a rate, which one will you accidentally did the wrong decision? So if you're using this one, all right, if you're using this as a hurdle rate, okay, compared to cost of equity, the first one, yes, both also X. This is correct. Okay, no issues. But this one, all right, initially you didn't accept it, but the problem is the cost of the equity is actually lower. So this one is incorrectly rejected. That means you rejected it for no reasons, for wrong reason. Okay, it should be accepted. This one, no issues, remain the same, so good decision. And the last one, again, you accepted it because it got higher return. But in fact, the cost of equity is actually higher than the required rate of return. So this one is incorrectly accepted. That's it. So based on the hurdle rate of 11% and comparing with your decision on your cost of equity, it seems like project X and project Z is wrongly rejected and wrongly accepted. So Z looks like very profitable, 14.2% compared to the market of 11% required. But the problem is the cost itself is 14.38. I'm repeating it now. I'm repeating it now what I'm telling you again. Okay? So initially, the first part of the question, they ask you the expected return that the firms is only 11% cost of capital. So the internal rate of return, this is the promise that they give you. Based on the project, this is the return that you get. So based on the market, which is only 11%, 9.4% is lower than the market, so you reject. 10.9 is also lower than 11%, so you reject. So you accept the 13% and 14.2% because you think that is much more profitable. Okay? Then part B, they ask you again, which project should be accepted? So by right, if you go and calculate it, which one should be more relevant to be accepted? So in this case, you need to use the cost of equity. All right, you need to use the cost of equity because here, they already tell you the beta. They already tell you the T-bill, risk-free, and also your market return. So you calculate your cost of equity. So the cost equity for XYZ are as this: 9.5, 10.63, 12.13, and 14.38. So if you're taking this to compare with the internal rate of return, the cost of equity is higher than the internal rate of return. So that means the cost is higher than the return. Of course, you reject again. That's why I put an X here. Next, your cost of capital is 10.63, but then your internal rate of return is 10.9. So it's generating more return compared to the cost of equity. So of course, you're accepting this. 13% is higher than 12.13, you also accept. But lastly, this one you calculated for Z, your cost is actually higher than your required rate of return. So your cost is actually higher. So of course you reject this. So part C, now they ask you, which project is wrongly evaluated if you are only using the hurdle rate as a decision maker? So the cost of this one should be a better way. This should be much more accurate. But if you already initially use this as a decision maker, which decision is wrongly made? So X and W and Z got no issue. W and Y got no issues. They are same. X. So this is correctly evaluated. This is accept. This is also accept. So it's correctly evaluated. So this tick means correctly evaluated. But for X, initially you reject. But you see the cost of equity, that means the cost of this project is actually cheaper. So that means you are incorrectly rejected. Just because it did not reach the expected market return, you rejected it. But the fact is this project is actually profitable. So you already incorrectly rejected it. As for Z, it seems like the internal rate of return is higher than the market return. But the problem is the cost of this project is way higher than the return. So you're making a losses here. So you make a decision to accept it here now. When you calculate it, it's actually not worth it. You're losing money. The cost of equity is higher. So you incorrectly accepted it. So this is what it means. Okay, so I already put it in a comparison. That's why it's easier to see. Okay, in this table itself, you can see the comparison here in different colors.